look, there's going to be one more round of printing, and this is my opinion. And there's going to be one more round because there's going to be one more financial crisis. It's going to be more extreme than 2008. It's going to be more extreme than 2020. And when it happens, the spot price of gold and silver is going to go crazy. I don't know, $2,500, $3,000 in a few nights overnight. I don't know. I'm just putting out numbers, but it could be that extreme. The danger is like maybe at the point where you say, someone who sells gold and silver, like, I don't want to sell anymore. I'm just because I don't want the dollars. Then we'll know that we're in the end game.
Gold has risen more than 600% since the turn of the millennium. Though adjusted for inflation, it remains below the high of $850 touched in January 1980, which would be equivalent to more than $3,000 in today's dollars. Rafi Farber of the Endgame Investor predicts gold and silver's lasting value, projecting a potential $3,000 surge in spot gold due to anticipated monetary printing in an imminent crisis. He signals a crucial endgame, as sellers of gold and silver refuse to trade further, indicating an aversion to holding dollars. Gold prices climbed on Thursday, buoyed by a weakness in the dollar and Treasury yields, with investors awaiting crucial U.S. payroll data to help ascertain the Fed interest rate trajectory. Meanwhile, Rafi points out that despite the money supply contracting, gold has been reaching nominal all-time highs on a daily basis. Since April 2021, money supply growth has slowed quickly, and since November, we've been seeing the money supply repeatedly contract year over year. The last time the year-over-year YoY change in the money supply slipped into negative territory was in November 1994. Gold has been on a parabolic run since the beginning of October, rallying from nearly $1,800 to a new record high of $2,150 an ounce, scoring an impressive gain of over 16% in 2 months. Regarding rising debt in financial institutions, Farber posits that it could lead the Fed to increase money printing, potentially impacting gold and elevating the risk of hyperinflation if the public dumps the currency ahead of the Fed. Now we present the clips of Rafi Farber's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
It's axiomatic that gold and silver are the money, and and the dollar is just a derivative of that. So if you own the physical, it's not that easy to pick up your physical stuff, which you have to like take into a car and carry physically and move to a coin shop and then sell to them. Most people are not going to do this. People who want to trade gold and silver are trading GLD and SLV. It takes a button to click, and that's it, and it's done. And we already know from the numbers that we just discussed that they're not interested anymore. What I'm saying is more on a general level. Look, the money supply has been contracting since April 2022. What is that? That's like a year and a half, okay? Gold doesn't usually reach new highs when the money supply, meaning the dollar supply, is contracting, and it still is, and it still will until the Fed moves in and starts to reverse it, which means it has to do QE again. It's got to print more money. It's got to buy more bonds, which it's not doing. So the fact that even on our microscopic level where gold is moving to new all-time highs on a daily or hourly basis, that's something big. So don't take the sell-off from all-time highs that seriously. The fact that we're moving even to nominal all-time highs on an hourly basis is a big thing, considering that the money supply has been dropping at a record pace since April 2022. And that's going to reverse. And when it does, so if I'm saying is a fortiori, if the gold price is moving to new all-time highs on an hourly basis, if you're in the spot market, then imagine what it's going to do when the Fed actually reverses and the dollar supply moves to a new all-time highs past April 2022. It's going to be extreme. So this is just a warning, right? If you're really interested in gold and silver, then you'll buy now. I'm not saying anyone buy now. I'm just saying theoretically that you'll buy now while it's selling off after new all-time highs, while the money supply is shrinking. Like there's more here than just gold goes to all-time highs and then sells off. That's what's on the surface. Like dig underneath, and there's a lot more happening. That's my point. The direction we're going right now is down in the money supply. And if you're going down in the money supply and up in the debt supply, which borrows from the money supply, like something is gonna snap here. You can't have more borrowing of money from a lower and lower money supply. Eventually, you have to grow that money supply in order to satisfy the borrowing. The question is when that break occurs and there's like a huge meltdown in the market of some sort, like happened in the repocalypse or happened in 2008. These are all just reiterations of the same thing. Then what is the extent of it, and what happens? Well, if you in just a very basic zoomed out sense, right? When the Fed creates more money, it gives it to financial institutions which loan out that money, which then have more debt that they need to be paid back. So they need more money to pay back that more debt, which means axiomatically almost that these institutions need the debt to expand exponentially. So when the next break comes and these institutions that need exponentially higher debt to pay back their own debt that they're buying from the Fed or from the Treasury or wherever it is, when they need that, then the Fed needs to print exponentially more money. And the question is what happens to gold and what happens to people who need purchasing power when that next round happens. Like eventually the rounds become too extreme and people just dump the currency and then get ahead of the Fed. When hyperinflation can be defined in many different ways. One of the ways in the logic that we're speaking now is when the public gets in front of the Fed and dumps the money faster than the Fed can. The question that we all want to know the answer to is that going to be the next round, or is it going to be a round after? I think it's going to be the next round. Could it be the round after? It could be. I don't think it will, but whether I'm right about being in the next round or it happens, a year or two or three later in the round after that, I don't think it will. I'm just saying.
Rafi Farber highlights decreased gold and silver holdings in ETFs, such as GLD and SLV, suggesting diminishing interest among retail investors. High gold prices prompt profit-taking among existing investors, resulting in overall negative flows, as seen in Bullion Vault's 0.4% decrease in vaulted gold holdings in November, and GLD's 0.7% outflow this week, reaching its smallest size in 2 weeks. Silver's giant SLV ETF also continues to shrink as investors take profit, down 0.4% on Thursday to its smallest since May 2020. Furthermore, Farber talks about declining reverse repos and questions how banks will secure treasuries without surplus cash from reverse repo. A year ago, the use of the Fed's popular overnight reverse repo facility swelled to a peak of almost $2.6 trillion. Still, it has dwindled to about $834 billion as of Tuesday, marking roughly the lowest daily demand in over 2 years. Daily reverse repo totals dropped by about $1.6 trillion to just $768 billion last week. In the meantime, he mentions a rapid rise in open interest in the futures market, suggesting increased activity in physical gold and silver. Let's get back to the interview.
I noticed that in gold and silver are moving. When we say gold and silver moving, we're usually referring to the spot price, the price that you see when you're looking at the gold futures or the silver futures, and they're at a high or they're at a low or whatever it is. It's the futures price that's referred to, and the open interest in the futures market has risen very fast. Whereas the ETF market, meaning GLD, if you have like hundreds of thousands or even millions of dollars, or if you're a bank or you're a really rich investor, you're not really going to buy GLD or SLV. Maybe you will, but like if you have a lot of money, you're going to buy futures because that's where the leverage is, that's where the excitement is, that's where the real money is, and that's where you can actually get physical gold and silver if you're plugged into a brokerage that can deliver that future to you. And it's possible. I tried it and I got to a point, but I know that there are brokerages that do accommodate this. So if you're a big investor, that's where you will invest. And that's where the action is happening. Whereas in the SLV and GLD markets, the amount of gold and silver that those ETFs hold has not risen anywhere near its peak, which I think was in like 2021 or early 2022. They've fallen since then. So that means the retail investors, both in the paper markets, in the people who buy GLD and SLV to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars. They're not really interested in the market right now. If they were, then we'd see the amount of gold that these funds hold go up, because that's what happens when more people are invested in GLD and SLV, and they have to maintain their peg, like an informal peg to the futures market. Then they have to put more gold and silver into those funds in order to expand the share count, in order to keep the price level with the futures market. So the fact that gold and silver is the amount of physical gold and silver in those funds is falling means that the retail investors in those funds are losing interest. Also, in the physical market, we're not seeing that much. If you zoom out a little bit, back during the repo crisis, the repocalypse of September 2019, right? So interest rates suddenly went up to 10%, and nobody really knew why. Not even Jamie Dimon, let's say, like the bankster of banksters, the most powerful banker in the world. He didn't like come out and say 3 or 4 days before, like, there's a problem in the repo markets, and I'm an expert in the repo markets, and this is going to happen, and I know it because I have a doctorate in this stuff. This is all new stuff that nobody has encountered before, because central banks have never been this involved in the monetary spheres before. So yeah, it's legitimate to say that nobody's really an expert in this, and neither am I. I'm just looking at what has happened in reflection against what has happened in the 2 or 3 years in the past, because that's all we have to measure this. None of this is established. This is all just new money tools that are employed by major central banks that are using new tools themselves and using other new tools to try to balance it. So we're talking about a humongous pyramid here that's being balanced on both sides, and nobody really knows exactly what's going on. So just to get to your question more specifically, what's going on is from what I see, and I don't know any more than this, is that reverse repos are falling, and they're about to go back to zero. They fell $120 billion on December 1st, which is a new month, and they usually fall in the new month. And when they go back to zero, that means there's no extra cash. A reverse repo is when banks lend the Fed cash because they have extra cash, and they get interest on that cash the next day. So when the reverse repos go back to zero, there's no extra cash. So then if there's no extra cash, then what do banks buy treasuries with?
Gold and silver have recently witnessed significant movements, reflecting the dynamic nature of precious metal markets. The current sell-off in gold, following all-time highs, may present a strategic buying opportunity, considering the broader economic dynamics. How do you foresee the future of gold and silver markets, and what factors will play a pivotal role in shaping their trajectories? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.